So thank you very much, everyone, for joining. Welcome to our CIB Outlook 2021 webinar. It's a pleasure having everyone here today. I'm sitting in our beautiful office in Paris, together with my colleagues. So for those who don't know me, my name is Mathieu. I'm a partner at Eurogroup Consulting, and I'll be your host today. I'm leading the practice, as well as our London office. And I'm here today with my colleagues, Estelle and Maha, and will be your host today. A brief word about Eurogroup Consulting. So we are a global independent strategy and transformation consulting firm. You may know some part of our ecosystems. We have Inuo, Strategic Impact, our strategic advisory entity, La Javanaise, our data and digital accelerator, and also our leadership and innovation management lab. I would like to extend a warm welcome to our clients and colleagues in Singapore. We just opened our office over there. To support our clients in Asia and beyond. We also have recently launched our Positive Innovation Lab to discuss innovation levers and enable successful transformations. And lastly, for our French clients, you might be interested in our yearly barometer of French corporations, together with BFM, and is due very shortly. So today, there are a number of topics we would be interested in discussing. I'm thinking of ESG, for example, and the outcome of the COP26 for sustainable finance. I'm thinking about data and AI as accelerators of transformations, or operational resilience and efficiencies are disruptors to cost-income ratios. Those are all interesting topics, but today we decided to focus on two topics. The first one, where we will discuss the recent CIB market performance, and second, how corporate culture and DNA can be a lever for talent attraction and talent retention. So I will ask you to keep the discussion strictly confidential, so we can debate and discuss freely, and please do not reveal the identity nor the affiliation of the speakers or participants. So let me introduce you our guest speakers for today. I don't know if you can see the right slide at the moment, but we have 4 guest speakers today. We have Cecile, Chief Operating Officer and Chief of Staff, Natixis CIB in the UK. Welcome, Cecile. We have Jon, Head of European Bank Research from Credit Suisse. We have Seb, co-owner of Tricumen, and we have Hind, our experts on corporate culture and DNA. So let's start the first panel. So I'll ask Maha to join me and to start the first panel while I'm trying to repair my connection to the team.
Thank you, Mathieu. I don't know if you hear me. Can somebody confirm? Perfect. So thank you, Mathieu. Thank you again for our guests, Jon, Cecile, and Seb, for joining us and accepting our invitation. The first panel is about market performances, and we should start it with referring to the 2008 financial crisis. So the 2008 financial crisis started with the CIB sector contracting over the time, slowly but surely, in the prolonged context of low interest rates. Corporates and investment bankers and banking focused more on regulatory requirements, on cost-income ratios, on dividends, rather than their core activities and revenues. Too many constraints and less focus on the market and its revenues. But then March 2020 happened. Volumes and volatility spiked through the roof, and Q2 and Q3 2020 were rather extraordinary. One of the main questions is when, if ever, we'll be back to normal, and what is the new normal? In that context, Jon, could you please assess the performances of the sector over the last few years? Could you please share with us your point of view on that topic?
Yes, thank you, Mahan. I hope you can hear me well, and indeed see the slides that we have up now. So my name is Jon PEACE. I run the European Banks research team here at Credit Suisse. And as Maha said, just wanted to walk through the recent performance of the European banking sector, and then I'm sure in the Q&A we might come to the forward look as well. And if I could turn to my first slide, please. The chart that I put together first was just a long run look at European bank valuation and profitability. So I've plotted here price to tangible book and the 12-month forward return on tangible equity. And what we can see here is that obviously pre the global financial crisis, leverage for banks, particularly for investment banks, was very much higher. So they were able to deliver very strong kind of mid-20s return on tangible equity, and valuations were similarly at very elevated levels, 2.5, even nearly 3 times tangible book. But following the global financial crisis, we've had a steady dialing up of regulation. It's particularly weighed, I think, on the corporate and investment banks. That's where the bulk of the risk-weighted asset inflation has happened. And that's slowly driven down profitability. And in the last 5 or 6 years, low interest rates has been a further headwind to profitability and hence to valuation. Where we are today, we can see over on the right-hand side, we reached a new all-time low in valuation during the COVID crisis. We got down to literally under half of tangible book value. If you consider that in 2009, in the global financial crisis, we got to a low of about 0.7 to 0.8 times tangible book. It really was a very, very depressed level. Fortunately, we have bounced off of those lows over the last year. I'll come on to why, but we're still at a very low level in historic terms in terms of European bank valuations. If I turn to the next slide, please. I mentioned regulation as a key driver of lower profitability. Sorry, back one if I may. Back one slide. The other key driver of the last few years has been low interest rates. Now, in a sense, this perhaps weighed a little bit more directly on the revenues of corporate banks than investment banks. But the absence of volatility that accompanied the central bank actions, I think, certainly also weighed on the investment banking revenue pools. What I plotted in this chart was a look at just the level of the European banks index, the price index, versus the German 10-year yield. And you can see that very strong correlation. And European banks reached their low in price at about the same time that interest rates reached their low. Unfortunately, in the last year, as the COVID crisis has recovered and economies have recovered perhaps a bit more quickly than expected, interest rates are slowly starting to normalize. And so we have a little bit of a tailwind finally for sector valuations. Moving on to the next slide, please. I just wanted to draw a contrast between where European banks are valued today and where American banks are valued. If we look historically, I guess the US banks have always tended to trade at a slight premium. That would reflect higher profitability in general that they've had in the past. the US banks index is even more dominated by the big CIB players like Citigroup and JP Morgan and Bank of America than the European index is. But we can see that following 2009, the valuation gap between US banks and European banks has continued to widen out, and it's probably as wide now as it ever has been in history. US banks have recovered to, pretty normalized valuations for the new environment, trading at 1.7, 1.8 times tangible book, whereas Europeans are still at a deep discount to tangible book value. And the contrast with where valuations were back in 2009, I think, has been quite telling. Now, I guess one of the drivers of this has been market share. But if I turn to my next slide, please, and just think about CIB for a moment. So I won't dwell on this too much because I know Seb is going to come back on this in his presentation. But whereas commercial banks, which are the majority of the European index, felt the pain of NIM compression, net interest margin compression with low rates, the US banks are a little bit more driven by CIB. And the CIB revenue pool picked up quite significantly in 2020, given the rise in volatility through the COVID crisis. And all the three key investment banking business lines expanded quite materially in 2020. And although we've seen some normalization so far in 2021, and that will probably continue into 2022, it's still at a very healthy clip compared with pre-crisis levels. So CIB businesses have tended to do a little bit better than retail banks over the last couple of years. Unfortunately, though, as we can see in the next slide, the Americans have perhaps benefited more than the European players have from this. And what I'm looking here is that a long-time market share of the European investment banks versus the American investment banks, looking at a population of the top 12. And really since about 2013, Europeans have been ceding market share. Now, if we think about the last couple of years, there have been some special items in here. In the first part of 2020, the French banks saw some particularly outsized losses related to the dividend bans. There was also a little bit of noise in the investment banking revenues related to COVID related losses. So 2022 is perhaps a little bit more of a normalized year. Perhaps if there's some good news here, though, is we might be starting to see a bit of stabilization in European market share with some players, maybe like a Deutsche Bank in fixed income, a BNP in equities, starting to see a bit of a pickup in market share again. Just turning to my next slide, just thinking about the forward look from here. I mean, two things that have really weighed on profitability and therefore valuation in recent years have been interest rates and asset quality. And I mentioned the outlook for interest rates has started to improve. I mean, in some markets, like in Central and Eastern Europe, in Czech, for example, we've already seen some pretty aggressive rate increases. In other developed markets like the UK, we could have an interest rate rise, around the end of this year. What I'm looking here in this slide is the market expectations for the ECB interest rates, and I'm comparing the deposit rate today to where the market expected interest rates to be 12 months ago. And you can see that 12 months ago, we didn't expect the first interest rate rise until 2029, or rather, should I say, we didn't expect positive interest rates until 2029. Today, the market is expecting positive rates maybe by the end of 2024, and with first rate rises to come through in 2022, despite what Ms. Lagarde has said. So we've seen a pretty substantial shift in interest rate expectations off the back of higher inflation, which should be helpful for profitability of the sector. Next slide, please. I mean, the other kind of key driver of bank profitability over time has been asset quality. And here we're looking at European banks' loan loss provisions as a percentage of average loans. So back in 2009, the peak for credit losses was about 140 basis points of loans. Europe saw a slower normalization than the US did. We obviously had the Eurozone crisis between the global financial crisis and today, and we had a concerted effort by the ECB when it took over as a single supervisor to clean up some of the loan books in Southern Europe. So the normalization in asset quality has been slower in Europe than it has in the US. We got down to pretty low levels through sort of 2017 to 2019 before obviously the COVID crisis impacted last year. And at the time, it was certainly a concern that credit losses could become worse than they were in 2009, given the outlook for GDP. But in the end, what we saw is that government support schemes were so generous and so effective that credit losses peaked at only 80 basis points of loans. And we, of course, had a change in accounting policy to IFRS 9, which meant that this crisis, banks were making forward-looking loan loss estimates rather than booking the loan losses as they actually happened. And what we've seen in 2021 is that banks had actually been over-provided in 2020. The economic developments over the last year have been rather better than expected. And so banks have been in a position to release loan loss provisions booked in 2020 in the current year. And that will probably continue into next year as well. And we do expect earnings estimates for the sector to continue to rise as banks are able to release further provisions. And then my last slide, just to kind of wrap this all together into returns again and what the forward look for returns is from here. What I'm plotting here is return on equity. I've done return on stated equity rather than return on tangible equity. Very similar picture though. And I've compared what the actual return on equity the sector has delivered versus what investors had expected on the 1st of January that year. And what this shows you is that, in most years over the last decade, investors had been too optimistic for the year ahead and generally overestimated what the actual returns of the sector would be. Interestingly, this year, investors have underestimated the returns because asset quality has turned out to be better than expected. And as we look forward from here, we are optimistic that those returns are going to continue to rise because, interest rates are slowly pushing higher. Asset quality should be extremely strong. For the investment banks, they've faced some pretty tough comparatives on the revenue side of things, but to the extent that they're diversified businesses, corporate and investment banks, potentially with retail businesses as well, that normalization of asset quality, that steepening of the yield curve, those are both good catalysts to see some improved profitability. So we're pretty constructive of the outlook for European banks from here. And I'll stop there. Thank you.
Thank you, Jon, for these valuable insights and for this thorough analysis. Now, Seb, we've had just listened to Jon's point of view on the performance of the markets. What is your read of the performance of CIB sector markets over the past few years and pre- and post-COVID analysis?
Okay, thank you very much. So firstly, as an introduction, I'm Seb WALKER, one of the managing partners at Tricumen. For those that don't know us as a firm, we're a relatively small firm, but we specialize in analyzing the financial markets, in particular looking at corporate investment banking, transaction banking, asset and wealth management, and retail, although retail is really limited to the US and Europe. Our data that I'm going to present here is based on the top 12 banks that we see in the global banks, names you'll probably all know. We do have a larger data set that covers about 45 banks, but I've not bled this in because we have a bit more detail on the globals. What I'm going to try and do here is take you on, if you like, a 7-minute whistle-stop tour of pre-COVID, how life was then, what happened during 2020 in the depths of COVID-19, and then what we're looking at in the first half of this year, and the last slide, perhaps moving on beyond. So if I get the next slide, please. So I'm going to start off looking at investment banking. So here we're looking at debt capital markets, equity capital markets, the M&A and ECM business. So you can see on the left-hand side, we've got the chart of how things progressed throughout the 3 years and what we're forecasting for this current year. I guess the main thing, if we start at the kind of pre-COVID point, is Overall, where was the strength? Essentially, it was in US high yield bonds. This is where the market was tracking. This is what was happening. For the rest, we had a degree of cyclical weakness. We saw some weak M&A markets in Europe and in Asia. We also had a bit of disruption in the markets with some of the post-IPO flops. We had a move towards direct listings, an increase in private investing. And this latter point was actually a trend that we'll start to see rolling forward as we move ahead. Going into 2020, this is where the markets really took off, particularly on the debt side. So throughout the year, we saw record-breaking bond origination fees across high grade and high yield. Second half of the year then became more the story for the true investment bankers as ECM markets surge and M&A surge, particularly around industrials, utilities and real estate. The other thing I think is worth highlighting here is the increasing importance of private equity as players and the role of SPACs. So when we roll forward into the first half of 21, this is where we see overall the markets up again, driven much more by loan fees, high yield, particularly up 50% there. The high grade bond side was a lot weaker, dropping down as the market started to stabilize. Over on the sort of more ECM and M&A side, we see EMEA and APAC starting to drive that business, whereas perhaps in the past it had been more US driven, and also an increase in cross-border M&A. And this is where we start to see private equity and SPACs really coming to the fore. So accounting for about 35% by volume of that business in their involvement in it. So overall, I think if you look at investment banking, the trend has been one that has been perhaps more cyclical. Obviously, we saw a big demand for the need for debt finance during the crisis. But overall, I think the market is broadly optimistic, when we look at the profile for the rest of 21. I get the next slide, please. So fixed income was really where all the action was in the crisis. So we start off pre-COVID, things were looking pretty dire. If you had a fixed income business that was focused on the institutional markets, there was a lot of challenges there. We'd seen a lot of margin compression. Yes, business had gone on to a lot of electronic platforms, but it wasn't fully electronified. And this meant that some of the benefits that you could get in terms of reduced cost incomes hadn't really bled through. The macro business overall was, I think, the one that suffered the most. And if you look back over the last number of years, the macro business from about 2010 really has shrunk, driven by margins, driven by transparency, driven by electronic trading. So where were the sweet spots? Well, it's pretty much limited to corporates. And if you are a bank that is focused more on the corporate business rather than institutional, things are ticking along all right. There's by and large been an increased focus by corporate treasurers on the need for risk management and a greater willingness to take part in those markets. Stepping into the crisis time, this is where we see a huge boom. Flow rates, flow credit, really driving this market growth. And it's interesting that if you compare with the last financial crisis, which was very much a story about the short end, about the need for financing, and indeed later on into the crisis, some interesting plays to be made in the distressed debt market. This is not something we saw during the COVID times. Distressed debt down 63% in terms of opportunities. What was driving the business from the client side? Hedge funds and banks being the two key segments. And the other thing that's worth highlighting is this is very much an America story. Yes, Europe and EMEA and Asia grew, but the Americas are up 43% in terms of the revenue profile year on year. Rolling forward into the first half of this year, we've seen the markets normalize a bit. So foreign exchange, G10 rates back down, not fully to the levels they were, but dropping back down significantly. We've seen the margins normalizing. We've seen financing coming back. But credit markets overall have held out pretty well. And we expect them to remain flat year on year versus 2020, which given some of the rises we've seen in those markets is a positive situation. The other thing I think is worth highlighting is in that credit side, we've seen a few banks start to focus more on the alternative business. And by that, I mean looking at opportunities to do asset-based financing using some of the structured credit technology. Looking at technology on another side, though, this is where I think we see a trend across this whole period. So I mentioned pre-COVID, we had this, we'd had a growth in electronic trading, but it pretty much stabilized. The financial crisis has really driven a lot more on that side. People working from home were starting to use some of the technology that banks are putting out. And I think one of the key areas within fixed income now is how banks are going to connect with their client base using technology and increasingly using AI and ML, a topic we'll come on to later. I move on to the next slide. So turning to equities, you'll see on the left, overall, this has been a story of growth. And we're forecasting quite a positive situation in full year 21. Stepping back to full year 19, however, the situation perhaps didn't look as so rosy, particularly for some banks. On the cash equity side, we'd seen the impact of MiFID II, driving greater transparency, driving disruption around, particularly colleagues who've worked in equity research, and the unbundling that took place there. On the other hand, that promoted some interesting pieces, and we've seen a real shift towards thematic research, towards new ways of looking at the markets that I think are quite exciting. Moving on to the derivatives side and thinking about risk management, this is where we see some of the issues. So falling equity derivative revenues in full year 19, number of banks seeing equity derivative losses. Now, I've also highlighted Archegos there. Obviously, the losses weren't in full year 19, but if you trace the roots of the problem back there, we can see that's a risk management problem that started in full year 19, with Archegos starting to demand lower margin in their business. Stepping into full year 20 and the crisis, again, it's a story of flow. Flow equity derivatives up, the electronic cash equity business up, less a story about the structured business, down 14%. We still also see some equity derivative losses, particularly in the first half of the year. On the client side, it's less an institutional story, and although we see hedge funds being a key segment, the interesting bit to note there is the corporate business was up 28%, and some of that was driven by that strength in financing derivatives. Looking regionally, Europe was down, whereas most of the growth was seen in Americas and Asia. As we come into this year, first half of this year, we've seen a bit more normalization in the markets. So the structured equity derivatives business is now back up and balanced by a decline in the flow equity derivatives business on the index side. The other things I think worth highlighting are the increased focus on global family offices as a source of revenue for the equity business. And again, hand in hand with that is the importance of technology. And here I'm thinking on two levels, really. Firstly, how banks connect with their client base on the technology side, but also looking at the risk management technology that enables banks to stop some of those losses that we've seen over the past few years. And get the next slide. So looking ahead to 2020 and beyond, I wanted to highlight firstly, how we see some of the market environment. None of this perhaps will be a surprise to you. So we're expecting volatility to continue, and indeed some of that is driven by disrupted supply chains and the impacts that they may have on the markets. Inflation obviously is there with increased interest rates, but the extent to which that may be a challenge for central banks going ahead is something of an unknown. We can also perhaps start to see, looking longer ahead, the impact of climate events as being an increasing importance in the markets. Obviously, US and China remains an imponderable. But the other one in terms of the market environment I wanted to highlight was AI and ML investment. Certainly at the top banks, this is becoming a real theme that is driving substantive changes in the business. And some of this leads into the opportunities. I think for each bank, people are increasingly looking at what is the hidden value in their data. By this, I mean client data. What are the relationships your clients have? How do your clients connect together across the CIB space, across the commercial banking space, and indeed in wealth management? Another interesting area that we see growth in is ESG, and genuinely as a revenue generator. If one looks back to the dot-com years, or indeed the focus on fintechs and so on that we've seen, technology companies, ESG could equally be this kind of sector. And we're now seeing a number of banks looking at who are and where are the small companies that have the solutions to the climate crisis, and how do you support them and build that relationship with them such that you can then provide the financing as they grow, or provide the M&A opportunities, or provide the IPO when they get to a certain size. And we think this is one of the exciting areas. Certainly a number of banks have been following up on this, and we're starting to see ESG as a genuine sector, with a few banks running this as a P&L center. The other opportunity is individuals, institutions, to steal some of the nomenclature. Yes, the links between the CIB and wealth management are well known, but starting to think about this client base as one, I think, is an increasingly important thing. This has been driven initially from Asia, where a number of banks have really managed to extract great value from the thinking of the jointness between the corporate and the individual running a corporate on the wealth side. But we're seeing this now increasingly flow into the European business and the US business. Lastly, I just want to highlight some of the decisions that banks probably have. So I put London as a financial centre up there, although I don't necessarily think it is one, but who knows what's going to go on between the UK and EU in this current tumultuous relationship that is taking place. The second one, I think, is much more substantive, and we're definitely seeing each bank look at how they tackle the AI ML agenda. Do you build? Do you partner? Do you buy? And getting that right and how you embed that in your business, I think, is definitely going to be one of the key answers to driving lower cost incomes, particularly for those banks who want to service the institutional client base. Lastly, I wanted to pause on a question. What are the key skill sets for capital markets? In the past, it's been very much around risk management, about client coverage, about trading, and so on. Increasingly, I'd suggest there's a different skill set that is becoming more important. And to highlight this, one piece of data I'm going to drop in there is we looked at one of the leading banks and did a survey of their headcount in the markets area, their producer headcount, the front office staff. And now they're looking at 30% of that headcount being actually people who are either quants or data scientists. And I think this gives you some level of the way in which that market is changing, and where in the past we've seen perhaps technology as a support function, now that AI, ML, data science area is very much critical to and central to some of the business.
Thank you very much. And especially for the last and beyond analysis that really resonates. That was really interesting. Now let's focus on one example of a bank, Natixis, and the following question is for you, Cecile. Would you please comment on Natixis' performance and maybe tell us what is your watch for the coming quarters and coming years?
Yeah. Thank you very much. So yeah, I'm Cecile de SOUSA. I'm the Chief Operating Officer at Natixis here in London. Well, I'm sorry, I'm gonna maybe play back a little bit what Seb just said, because the story that Seb walks us through is very much what we experience at Natixis, especially during, the 2020 events and the 2021. Like most of the banks, indeed, we saw this year as really, represented really a big rebound. And we recently published our results, and indeed we can see, especially the beginning of the year was extremely vibrant, and we kept the trend for the last quarter. Credit for us is one of the assets where we capitalize the most on our expertise, and indeed playing on the good market conditions as well help us, and having the credit technology was definitely a plus. And on similar, still in global markets, the pickup on equities as well. For us, it was also a question of let's say a strategic refocus. Clearly, the 2020 year, made us think a little bit more about what is the kind of business that we want to develop. And with the recent announcement as well that we are simplifying our organization with our holding company, BPCA Group, this was definitely an opportunity to see a refocus on some portion of the strategy. So you mentioned, Seb, for example, the difficulty to manage risk, and some banks may have chosen to be a bit more on the flow and capitalize also on a lot of really dynamic infrastructure. For us, it was a lot about refocus on who are really our core clients, who are the one where we want to invest our capital, our risk capacities, and for the equity franchise, that was definitely a good bet. And if I flip onto more IB side, well, the although our real estate franchise has definitely been playing a big part in our growth this year. Maybe some of you do not know that, but strategically for several years now, we have tried to engage more actively in ESG, and in particular green financing, and how we can help manage the climate change risk. And so this year we've seen, it has started last year already, but we've seen a lot of great transactions helping our clients transition, go into the path of transition, or directly asking for financing of pure green solutions. So definitely 2020 was a year of losses, but also the capacity to take a step back and think about what is the new model that we want to roll out. So I think, like most of the banks, the next years ahead of us are going to be to keep on working on the diversification. This is very apparent in your data set. Indeed, that there's a lot of opportunity to take in all the different franchises. So diversity of client, diversity of geographies, but also for us, something that we really want to focus is the green. So I think we're going to hear a little bit about what happened in Glasgow, but this is something we've been following a lot. And something that indeed was a little bit more as an underlying factor for us is becoming much more prevalent in how we make decisions, especially on how we want to invest our balance sheet, is the data. That is definitely something that us, like a lot of our competitors, we're looking at. We manage so much data, we collect so much data on our transaction, on wallets, on market trends. Okay, but how we really give ourselves the power to incorporate that into our day-to-day activities and not just retrospectively look at it. So those are going to be those key elements: diversification, more green, being more powered by technology are, let's say, the key pillars for me on the takeaway for the next years. On the UK side, because I sit in the UK right now, so we mentioned briefly something that happened a couple of months ago now, which is Brexit. So the cost of risk of the regulation may be a new factor that we want to look at, as we've seen recently some messages from our regulator starting to diverge a little bit, so being a bit more UK focused in terms of adaptation will be another pillar for us to develop in the next month.
Thank you very much. Clear. Take some questions. Are there any, Mathieu?
Yeah, so let's make it interactive and get some questions on the panel. But in fact, I do have, and I'll be very selfish, I have a question first on the back of my mind. This is about share buybacks versus M&A activity. I know banks have been focusing on short-term ROI with share buyback programs, I think, and they've announced again on this Q3 result round share buybacks programs. But maybe directed to Jon, maybe the question on what can we expect in terms of consolidation in the sector. Any views on this?
Yes, thank you, Mathieu. So in fact, I have two final slides prepared just for this. So in brief, capital levels basically are at records for the sector at the moment, and that's come through some reasonable profitability, some regulatory easing, and the dividend bans, of course, have allowed some capital to roll up. So if we look at the forward dividend yield of the bank sector versus the market, it's basically at a historic high. If we were to add share buybacks on top of this, it would probably be at a record level right now. And increasingly, we are seeing share buybacks being approved by the ECB. But as you say, it's not the only potential usage of capital, and M&A is another very interesting alternative. If we look over the page, one more slide ahead, I've got a picture of, here it's just the volume of M&A within European banks, and I've overlaid that with the value of the European Banks Index. So we have finally started to see a little bit of a turn up in M&A in 2021, albeit from some very, very low levels. I mean, we have to go back really to 2009, even 2007, before we saw significant historic volumes on M&A. But it is potentially an interesting alternative, and just this week, for example, we had a few transactions yesterday with BNP buying or potentially selling its US business to focus on profitability, KBC buying in Bulgaria, BBVA buying in Turkey. So it's definitely picking up. I guess. Where we have in-market consolidation, it makes a lot of sense still for investors. You can get big cost synergies out of these kind of deals. 30–40% of the cost base is not unusual. So these kind of deals tend to be really welcomed by the market. And bolt-on deals can always be very sensible as well. I guess what we've not seen for a while, and where perhaps the regulation still isn't set up to really help us, is those very large cross-border deals that we saw in kind of 2007. And I think there's a few things holding us back. One is regulation, perhaps the completion of the Capital Markets Union. Another one is some of the regulation that's gone in place post-crisis, like the GSIB rules that make it quite capital expensive to being a big bank. And another one is valuation. Targets don't necessarily want to sell out at these historically low levels, but I overlaid the Banks Index price with the M&A volume to show that as prices recover, M&A does tend to pick up. So I think the outlook there is definitely increasingly bright.
Okay, great. So we might see eventually some consolidation. Thank you very much, Jon. And just to reflect on what Cecile mentioned to us on Brexit, have we seen the effect yet, and has the impact been quantified? Maybe, I don't know if Cecile, Jon, or Seb, you want to comment on this? No one wants to comment on Brexit. Maybe Jon, you want to start?
Wow, it's a difficult thing to try to quantify. I think probably everyone would say it's been a cost all round rather than an opportunity. Has it been an enormous cost? Well, we probably do see it in the financial statements, a little bit of CIBs, but equally the top line has been very powered by COVID and the volatility that's created over the last couple of years. So at least it's created an environment in which there's been some good revenues to absorb the changes. I guess probably we would imagine there can continue to be some movement of headcount, some movement of market share from London to the continent, but at a kind of group consolidated level, probably the peak of the spending is behind us.
Yeah, I think my perspective would be that it's been more of an irritant than something that substantially changed the market. Probably irritant is definitely the right word all round. But I mean, as an example, where we've seen teams, that have been 100% based in London in the past, typically it's maybe one or two members of the team moving to, say, a Paris office. So that headcount movement hasn't been as substantive as some perhaps predicted. But there's still uncertainty, and I think that's one of the challenges, is we see the unpredictability of the relationship going ahead, and that's something. I mean, I spent a number of years in the UK civil service, and I've not seen anything like that since I was there.
Yeah, no, I agree as well. irritant, I think it's probably a good word. It's true that probably in terms of spending, in terms of change management projects, it has cost banks a lot. But then it just happened at the same time where there's been huge market disruption, so very difficult to see it. And also, it's not stabilized yet. So I think this week only there was a decision to postpone other decisions on the CCPs. So the market infrastructure is not yet stabilized so that we can really see, the before after Brexit.
Okay, yeah, I tend to agree with that. Thank you very much. Thank you, Jon, Cecile, Seb, for this. What I'd like to do now is to keep the last 15 minutes for the second panel. Estelle will interact with Hind and Cecile, and what I'd like to discuss is how corporate culture can be a lever for talent retention and attraction in this very tight market conditions. So over to you, Estelle, and we can take questions as well at the end. Thank you.
So, hi everyone. I'm Estelle. I'm senior consultant at Eurogroup, and I'll be the one to animate the debate today. So I have seen during the first panel, we have evolving in the market industry at the beginning with high activity, which led to a high demand in terms of workload and workforce. So one of the main CIB challenge lately has been to better attract and retain talents. So because of structural and conjunctural events, the way HR has been addressing this job market is evolving, and also because of transformation plans and cost reduction plans for CIBs, we can understand that all these factors are really impactful in the strategies for both HR and transformation offices. The job market is tensing with fewer talented candidate pool, with high demanding candidates and employees in terms of salaries and packages, and a fierce employer competition with the new market players entering the market with fintechs, etc. So in order to try to deal with this ongoing talent war in the banking industry, Eurogroup Consulting have tried to give some thoughts on practices for CIBs to leverage on the DNA and corporate culture to differentiate and better appeal to candidates in this evolving job market. So to discuss this topic about talent attractivity and retention, we have today around the table Cecile, Chief of Staff at Natixis UK, and who's going to help us understand how the banks are trying to face those issues. And also we have Hind, Principal and Expert on Corporate Culture and DNA at Eurogroup Consulting. Hi, Cecile and Hind. Hello. Great to have you today. So maybe Hind, you can introduce a bit yourself and what is the DNA framework that Eurogroup Consulting have built and how it works and what is this purpose?
Okay. So thank you. I hope everyone can hear me well. So I'm Hind, LAGHMAM principal at Eurogroup. So it has been 10 years that I've been leading transformation and change management projects. As you all know, we are in an evolving, continuous changing world. And I come across this DNA topic in 2015, where we developed it with Eurogroup. So to start answering your question, Estelle, you may have heard of a saying that culture eats strategy for breakfast. So it's a strong statement. It comes from Peter Drucker, who is a famous author in the management field. So a strong statement that says that cultural traits and characteristics are as powerful as it can get in an organization. Which means that for us as people that want to transform help our clients to transform, it's a great lever to use in our projects. So these cultural traits, either it facilitates what you want to do or it can restrain it. It can have impacts on social cohesion, on the engagement of your employee, and also on your transformation project. So this is why we started this framework, saying we have a great lever at our disposal. We need to make something out of it. But corporate culture is something quite difficult to grasp as a concept. So we try to make the implicit explicit, because when we talk about culture, you have different words that you can use. We talk about values. We can even talk about the dress code of your company that says something about what your culture is. So this framework helps bringing it to the explicit. And this is sector agnostic. When we started this diagnosis and DNA, we started with insurance company, we moved to aeronautics, then to all other mobility sectors, for food industry, and also banking. The first time I used it on my side, it was a prospective study we were doing for the mobility sector. And we were trying to see if the DNA of the company was fitting with the simulation we were making of the market of the mobility, to see if we are in line or if we had something to do to make the culture progress towards what we wanted. And actually, the way we developed it is across really like a DNA, as you can see on the screen. It's chromosomes. We have 7 chromosomes that deal with management mode, decision mode, action mode, your relationship to your company, your relationship to your job, your work life. And each chromosome has a set of 2 cultural traits. For example, in the management chromosome, you can have agility versus stability. And what the diagnosis tells you is what is the weighting between stability and agility. For example, you can do the exercise on your IT department, find out that 87% of the employees are going towards stability. So they are more comfortable with a stable environment. And you are launching a bunch of agile projects. So maybe this can give you food for thought on how your corporate DNA is matching with the initiative that you are launching. So the idea when you launch this kind of diagnosis is not to make it very hard to to administrate or to analyze. So when we do it, we send a questionnaire. It's 47 questions. So you choose between the 2 cultural traits of each chromosome, and at the end we consolidate. It's automatic, and you have the results of the weighting on the different chromosomes. Sorry. So, so the diagnosis in the end is a tool that tells you, sorry, what tells you how your company is naturally functioning. It tells you also what are the trends you're going towards. So, for example, your 87% stability team in the IT department, maybe they are moving towards more stability, or maybe they are moving back to more agility. So you have also, so you had a photograph today, and you have the trends in the future.
Okay, amazing, great. Thank you very much, Hind. Maybe Cecile, you could have a word about this. Is this DNA thing resonate to you? And also from Natixis' perspective, which cultural assets do you highlight, especially in recruitment processes, but also during the employee life? And what are the main measures you've undertaken, maybe during transformation plans or your current strategies?
So there's different questions in your question, and it's a very broad topic. So what I really like in this concept of DNA, it really plays on different factors. And it's really give the signal that, you don't have a cookie cutter approach to this. So we don't analyze the DNA of our teams, but what we analyze is the moods. So we've partnered with a company that help us do some surveys where we can appreciate the mood. We take the pulse basically of our teams at different moments. So we kickstarted this last year, and hearing those feedbacks, seeing how people are feeling at some certain moment, help us to drive some conclusion about their engagement, but also some risk that we're gonna be seeing looking forward. So what's really good is that you can see it indeed into different portions of the company. The mood is not the same at the same time. And when you go through external difficult events, but also internal transformation challenges, I believe having a way to keep a metric on either the mood or the traits, the characteristic of each team allows you to have a much more focused approach. But then what we face as well in this concept of culture, corporate purpose or corporate culture, it's about finding some values that actually help people understand that they are part of a community. So what we did last year was to release a set of values that are around collective intelligence, sustainability, and entrepreneurship. And basically we launch activities and events that are geared toward, one, the recognition about playing with those values, but also the promotion of behaviors, activities, initiatives that fit into those values. So the concept of a culture itself is a bit too high level to really manage to convey a message, but by peeling it down at values level gives also some targets. But then I don't know if it's something you've seen as well. We had this concept before as an industry. We were talking about culture fit when we were discussing about hiring, recruitment. But we are faced right now also with another challenge, is that we need to progress on diversity and inclusivity. And by definition, talking about diversity, it's very difficult to merge the concept of culture fit and diversity at the same time, especially here in the UK when you talk about multicultural presence and fostering a more multicultural work environment. So that's why I really like this approach, to really try to focus a little bit more at granular level, because you are able to address activity that help to, how do you promote loyalty? How do you promote individual growth? How do you promote also your purpose, but with a different message that is given to actually subcultures of your company, if that makes sense. So it's a very long journey. So anything that we can do that helps, make a sense of belonging, it's something that we've seen also praised a lot by our staff. Especially we've seen the change of generation as well. I don't know if this is something you observe as well through your studies. Yeah. But we are in the new journers, especially the younger generation, what we see is that really they are super interested into everything that we can do in terms of community, being internal community. How as a bank as well we relate to the community that are around us. How can they be part of it? And how through our corporate purpose, which is to be a bank, so to finance some portion of activity, how this relates as well. So the promotion of transaction and, stimulating staff into doing their best with this with those values is proving something that it's paying off at the end if we want to keep our teams with us, facing. I think we've all seen the great resignation challenge or fear coming up. So this is just another tool that we need to deploy.
Yeah, especially individual with the pandemic. We see that people aspiration, especially from the young generations, have evolved. and the banks need to adapt, but also to adapt the strategy. And the DNA assessment could help understand what is the gap between what is the culture the bank would like to develop within the transformation and how the the employees actually perceive the culture. So in this changing environment, Hind, could you explain how concretely the DNA assessment could help build the right talent strategy in order whether to attract or retain the talents for the banks?
Well, first of all, I think the general assumption is that in CIB, you still have some attractivity in terms of sectors for junior employees, even if the market is quite tense because we have a lot of activities, so a lot of workforce to have. So the DNA you expose to the market actually and the values that you promote are the markers of your company identity, and this is what the newcomers, the new joiners are searching for, especially new generation. We all know they are increasingly seeking for more sense and more purpose in their jobs. So they're gonna be interestingly looking at what you display as values and as a DNA, what represents your corporate DNA. So it's a way to differentiate and it's a way to attract. You need to be true to yourself, because what we see actually is that in terms of retention, what happens is that new joiners catch your DNA at the first stages of the interaction, so at the recruitment process. But when they get into the companies after a few days or a few months and even a few years, they see the reality of it. If what you sold in terms of promise, in terms of DNA, in terms of values, if it's really true or not. And this is where the retention could become difficult, because if you have a discrepancy between what you expose and what the reality of your company working, the higher the return, the turnover you can get, because you didn't deliver the promises you made to these people you recruit. So I think that just to finish up, the corporate DNA assessment, what allows you to see what's the reality of your company DNA, to compare it to what you deliver in terms of storytelling about your company, and make sure that you align this to put on the market an offer that is consistent with the reality of the field and the way your company works.
Okay, great. Thank you very much. We are a bit running out of time, so we'll have to conclude. I want to thank you, all of you, for your contribution. Cecile, Jon, Seb, Estelle, Hind, and Maha, thank you very much for your help on this. We'll be publishing our yearly CIB Outlook very soon, so we'll distribute, and you can find it on our regular channels. Thank you, everyone, for the participants. There were other questions we couldn't take, but I'm sure we'll come back to you. Thanks again, and enjoy the rest of the day. Thank you very much.